Good morning or good afternoon, everybody. Welcome to today's webinar, Jumpstart 2025 with Fix and Flip and Ground-Up Financing. Now, we want this to be as interactive and engaging for you as possible. So as questions come up, go ahead and use that little questions tab, and I will ask the speakers on your behalf. So with that, I will turn it over to today's speakers. Take it away, Jim.
Well, thank you, Rose. Good morning, everybody across the United States, where the temperatures are anywhere between 80 and -10. Hopefully you're somewhere it's warm. Real quick, a couple things about LendSure, and we'll get into some fix and flip dialogue and introduce to many of you our new ground-up construction for new homes. About us. Rose is working on the next slide. LendSure began its operation in 2015, so 10-year anniversary. Yay for us!
Sorry, guys. My apologies.
That means we're getting older. Oh, did I say that? So LendSure is set up primarily as a non-QM lender with 8 fantastic products. We've been doing that for 10 years, as we mentioned. First-in-class loan performance. We're very proud of our 10-year history and where we're at today. We do loans in all 50 states. And all those green states you see there, every one of them states has plenty of homes that need repairs. They all need some repairs. So the volume here is infinity for you guys. Okay, that's enough about us. Let's talk about fix and flip, Lori.
Okay, good morning. Lori Williams, the account executive for Fix and Flip. Happy to be here this morning. Welcome, everyone. When we speak to fix and flip, it's also fix and hold. So if we say fix and flip, it also refers to fix and hold. And that's just an exit strategy. On these products, we go from zero flip experience up to somebody that's done 25 or 30 of these. It just determines what their down payment is. And it's designed for that investor that wants to purchase, fix and sell, or purchase, fix and hold their investment product. We find this to be not a one and done situation. We have many repeat clients. They get through one and they've come back to us 2, 3, and 4 times, all the time back through you. The ease of this product is that there is no IRLA, no 1003, no income, no DTI, no TRID, no prepayment penalty to the borrower, and no EPO to you. We're not going to come back to you and ask for your origination fee back if they finish the project and pay us off in 4 months. The term is a 12-month interest-only balloon, no prepay, no EPO, and the payoff is either through a list and sell or come back to you to refinance it into, let's say, a DSCR loan and retain it as a rental. And the good news there is you get 2 loans in the time it takes them to do this. That's a good exit strategy. Fix and hold, 2 loans for you.
2 commissions.
Yes.
Good news.
Now, Jim, before we go into the next slide, I understand that we were having a little bit of audio thing. So if you guys could just do a quick thing in the questions. Can you hear me okay?
Yes. Loud and clear.
Yes. All right. Thank you so much, guys. Thank you. Lori?
Thank you. Thanks for checking the audio. So again, we spoke about this already, the BRRRR method. I use it as rinse and repeat. Your borrower does one of these and then they come back to you because it was easy and we've already got their LLC documents. We can pull docs out of the old file, update some assets, look at the property, look at the new property and get an approval out very quickly. The loan is short term for the borrower, 12-month interest only with no prepay. And the good news is when we looked at the loans that we closed last year, the return on investment was 23% for the investor. Pretty sure that's not what the bank's paying them on their savings account. So that's a good return on investment. And let's say they flip it in 3 months, that would double, right? That return would double. So
time is money?
Yes, we speak to return on investment to you often and to your borrowers to ensure that they're going to make money on their project.
That BRRRR Lori talked about, I know it's BRRRR back in the East and in the Midwest, but really it's buy, rehab, rent, refinance. So like she said earlier, 2 loans for you. Next slide, please.
Now, Jim, we do have a question. Ronald wants to know, what's the biggest difference between hard money lenders and LendSure?
Pricing, people think it's a big difference. It's a big variance between hard money and LendSure. It's relatively the same. There's not a big difference in interest rate. Loans on homes that have been demolished are risky loans. Therefore, interest rates vary between 10 and 12.5% on LendSure. There's not a big difference in hard money and what we price. These are risky loans, as we all know.
Okay, and I've got a couple of questions about the slide deck itself. Yes, look, yes, it is. You will get a copy of the slides. Look for an email from me, Rose Waldy, about an hour after the webinar ends, and that's going to have a link for you to download the slide deck, as well as a link to rewatch the webinar.
So this product is for the their already, growing investment portfolio. And it definitely is a way to, if you buy and fix and hold the property, more than likely the borrower can go ahead and realize a higher rent and better cash flow, which is a good thing for your investor. And again, the 2 loans instead of 1 is for the investor that's going to fix and hold. I don't have the exact numbers on there, but if you made me guess, I would say 50% of the products that we do are fix and sell, and the other products are fix and hold, because I just see that a lot where in different markets, people want to hang on instead of selling the property. And the other thing is, if they tell us up front that they're going to rent it out, and mid construction, they decide that nope, they're going to sell it because somebody was driving by and saw the work and said, wait, I want to buy that property, and offers them more than what they thought they could get, they can absolutely change the exit strategy. They're not stuck to just one of them. As long as we get paid off in those 12 months, either exit strategy works for us, even though we ask up front what the exit strategy is.
Next slide. Thanks, Rose.
So here's an area where I just got off the phone with somebody about this on these stalled projects. It's our understanding that most of our competitors run when they see these. And this is the combination of your borrower bought it for cash, started using their own cash for it, and they ran out of money. And now they're coming to us saying, I'm in the middle of this, help me, help me. I bought it, I've got 150 of my own money in it, I need another 150 to finish it. We absolutely look at those. We define those as the mid-stall construction, and we see those often. Oftentimes, we'll also see them on a refi basis where they owe money to somebody else. Those are a little trickier for us. And if you're on the phone with me, I'm going to ask you more questions about it. It's not a no. We've closed them. Who do they owe? Is the balloon due? Did they go back and ask for more money? What did they say? Those types of things, but we do close those. So don't be afraid if they're in the middle of a project and they need money. Just pick up the phone and call me and let me answer some of those questions up front before you get it into the scenario portal. So we definitely look at those and we definitely close those.
You see that word regulations? I'll bring that up because sometimes it's not just a money issue. It could be, some cities use the term red flagged. Somebody from the city has stopped the construction for one reason or another. And that could be a month or 3 or 5. Meanwhile, that first mortgage loan that they took out could be ballooned and coming due. So we look at these situations as well. It's a great product for us. Lori mentioned many don't like these. They get uneasy. We will look at them.
Okay. Jim, I've got actually quite a few questions on the property types. Can you do 2 to 4 units, manufactured homes, condos, condo hotels? So can you tell us a little bit more about property types?
Want me to? So yes, in general, we go up to the 4 units, so that's not a problem. So single family, no manufactured homes, that's not allowed on our product. And we do condos. I believe condotels is an exception for us. So again, if you're unsure about the property, then you call or email me the property address, but definitely up to 4 units. I define it as no mixed use, no commercial, no large acreage. We're not afraid of properties designated as rural, but if you look at the property and you see 40 acres of trees, I'm pretty sure I can't do that. Ever questions about a property, just call me and I'll look up the property.
I just got one, Lori, what about a log house?
I believe log houses are in our product as we can't do them.
Depends. It's rare, but sometimes they do fit. That's a one-off.
And it would be with log home comps and at a reduced LTC. So if you have the log home and it's not on 40 acres or 35 acres, or give us a call and let us know.
Okay, great. Should I go to the next slide?
Next slide, please. Hey, it says ground-up construction loans, relatively new for us. We've closed 5 or 6 of these, and we've got many pending in the books, on the books pending. Exciting times for us. There's a market need for this. Hey, I do have a construction joke for you. I'll pause. You want to hear a construction joke?
I'd love to hear a construction joke.
Want to hear your construction?
Hold on, I'm building it. Okay, who are these construction loans for? Let's talk about who they're not for. It's not for the owner-occupied husband and wife, wife and wife, husband, whatever. It's not for owner-occupied people trying to build their own primary home. Program is designed for investors and builders who seek to build a home on spec or to sell the home, or we'd like build to rent. That works as well. 1 to 4 units, average return on these is very high, as we know. That's why builders build these. It's a nice return. Again, Lori wants me to mention it twice. Not designed for owner-occupied single family. We're going to live in the house. Next slide, Rose. Loan size, you can read it there, up to 4 units. The big thing about these is the lot approved and buildable? Does the investor builder have a lot picked out, already owns it, may or may not, but the lot must be approved by the local authorities with services at the curb. We're not doing, ground up loans in the middle of nowhere where we're building roads and sidewalks. We don't do that type of lending. We'll do an example here of what a loan looks like and how much can you borrow, but generally speaking, up to 60% of the purchase price of the lot, not the house, up to 60% of the purchase price of the lot. Investor cash in, down payment matters. We don't do any kind of 100% financing. But I said 60 on the lot. On the cost to build, we call it CTB, up to 85%. So we do the math there twice to come up with a total loan. We'll show you an example. Experience for these types of loans really matters. We look for 3 new builds experience, or if you had a builder that's built 2, but he's also done 5 or 10 very extensive, high cost remodel jobs, the $1 million stuff, big plans, we'll consider that borrower as well. Next slide, Rose, thanks. Same as in fix and flip, LLC names only, no personal names. They're business purpose loans. We may ask about a borrower's income. We don't necessarily verify and require tax returns. On these loans, which can be larger in size, more work required. It can be up to 18 months for the term. Origination points, we do charge rate and fees. You can see there it says 2 to LendSure. We mentioned pro forma draw schedules. That's the holdback amount. How much money do we advance a builder on the project as he's building it? So all the funds are not, the money's not funded up front. There's an initial advance, maybe, could be or could not be. And then it's a series of draws from there as construction goes along. And before we issue draw funds, we do an inspection. Lender funded draws only. LendSure wants to control what's happening on the process. Inspections take place. People come out, people that we hire take photos. We don't ask you guys for a bunch of receipts. We don't want a stack of bills. It'll save you time by not asking for that. Next slide, Rose. So let's take a look at determining how much money you can borrow. Let's pick a price of $200,000 for the lot. Let's say he's paid for it. Cost to build's $400,000. That's easy math. $600,000. The ARV in this particular case is $800,000. So one might say 600 to 800. I just made $200,000. Is that really true? Is that the net profit, Lori? Lori's going to say no. There's going to be cost involved in that. But let's focus on the loan size, how much we can lend. On the lot, if they purchased it, a borrower builder could get up to 65% of what he paid. In this case, that's $130,000. $400,000 cost to build times 85%, $340,000. Just add the two numbers together. What's the total, Laurie?
$470,000.
He could borrow $470,000 on a cost of $600,000. So that would mean $130,000 is coming from who?
The borrower.
Be coming from the borrower. Closing costs, I'm not going to read those to you, but that's just an example of what closing costs look like up front. The max initial loan for the borrower that qualifies $130,000, less closing cost. They can walk from the table on dirt only, nothing's been built. They can walk with cash in hand. That's a big niche for LendSure. Not many people do that. We're making a loan against some land. So we mentioned 3 new builds, specs, plans, and permits. You want a permit before you start borrowing money, right? What if it took you 6 months to get a permit? You want to be paying Lori and us interest? Probably not. Location matters. Infill simply means there's already construction and homes in the area. The draw schedule we mentioned, the first draw would never exceed the builder's dollars into the project. The lender is going to lag the investor's funds into the deal. We're never going to be at 100% position. Loan ARV, same as fix and flip, 70%. So that's the basics of how much you can borrow. We might have a question or two on that. We'll be glad to answer it. Next slide.
I've got a couple of questions here, Jim, about, well, first of all, several people have asked again about owner occupied. What if can we do an owner occupied and have a general contractor do the work? Would that work?
No, with nothing owner occupied. And here's a 30-second reason. Because these loans have no IRLA or 1003, no income, no DTI, no TRID, and close in an LLC, they're entity loans, if there can be nothing that's owner occupied. So our product covers nothing owner occupied. That's the first question out of my mouth when you call me on any of these products. Owner occupied, if the answer is yes, we can't do it. And if it comes out in the middle of underwriting that it's going to be owner occupied, the loan will be denied immediately. So this does not cover owner occupancy.
Ground up building.
Wait, she has more questions. Are there other questions, or is that
Yes, yeah, no, I do have some questions. So I've got several people also asking about the draws. What are the costs for the draws? What needs to happen for the draws? Can you tell us a little bit about that process?
Generally speaking, the cost for a draw, initial inspection at the property, $300. Draws as we go through the process, $200 per draw. That's generally speaking. It could be less or more. That's just a general number. $300 up front, $200 per draw.
And on the ground ups, we definitely work with the contractor to determine the draw schedule, which is completely different than on fix and flip or fix and hold. That's really, the number of draws is really determined by the investor. But on this product, we work with the investor and the contractor up front to determine the size and the timing of the draws based on the work being done, so there's no surprises.
I would think the first draw would be something around reimbursing them for the cost of the foundation.
Correct.
not a new roof.
Correct.
It has to follow a natural, normal
Right.
sequence.
But again, because these are two experienced investors and builders, that should be nothing that's like unusual to them.
Not a surprise.
Okay.
So hold on to the questions. The buyer builder that wants to hold, do you think we have a housing issue in the US today? Do we have too many homes or not enough? I think we all know the answer. I think it's a huge opportunity for builders. We did a loan for a gentleman named Jacob in New Orleans. I won't tell you his last name. He built two units, very nice homes, two side-by-side, 2 units on 2 different lots, just on the east side of New Orleans. When he was finished and had the right to occupy issued, cert of occupancy, 3 days. He rented out all units in 3 days. So we know there's a huge demand for that. Take advantage of it. Rose, you got another question?
I've got a ton of them. Let's continue this for a little bit, and then I'll ask some more questions as they come up.
Okay, so we'll keep going and then you'll compile the questions for us, correct?
Yeah. Yes. So is next slide or is it this one?
Well, we mentioned the philosophy on who's it for. We're targeting the smaller builders. We're not doing loans for large builders that build 2,000 homes over the summertime. That's our primary target. Location-wise, we mentioned it, urban and semi-suburban areas. We're looking for, is it a community? Is the house near? Is there a job market? We mentioned here 50,000 people. We'll look at those, but we're not going to be doing new builds where we know resaleability becomes a problem. The flip economics has to make sense to the builder and to people here that invest money in LendSure. Real quick on what do we underwrite? Well, we mentioned location project. Does the project make sense for the neighborhood? Builder experience is huge. Credit and assets are reviewed. We like credit scores of 680 and higher for new builds. We mentioned, is the lot buildable? Yes or no? Neighborhood and services. The third-party feasibility study is what we call the draw process. That's the third party that we hire to go out and look at the project. Makes sense. Profitability for the investor has to be apparent. We don't want to put anybody into a loser situation. That's what we underwrite. On the top of that list would be experience and location.
Jim, I've got a couple of different questions about the experience. So, for example, one person said that what if they have a general contractor that's been a general contractor for 20 years, now just started his own business and has only done one project? Would you consider his experience as a general contractor? Would you take that into account?
That's a good question. So if the contractor has not put money into the deals that he previously worked on and did the construction, that's not his capital. Those don't really count. Now, you mentioned he did one new build himself with his money. That's something we would look at based on his overall experience and the size of jobs he's done in the past. Are they similar? Has he converted apartment buildings into condo units and done that over and over? So depends on their experience and what they've done and how much capital they used on their last project. But really we're looking for their money's got to be involved. Were they money in?
And I will mention, because we had one like this where on that Nelson file, where we did approve it, they relocated to North Carolina, and we did approve the loan, but at a reduced LTC. So we wanted 30%. We were not able to go to like 85%. It was approved at 75% as the exception for the lack of experience. And again, those are conversations that, they sent us their resume. We went to the president of the company with their resume. We talked directly to, in this case, the loan officer was the borrower along with her husband. And so we'll have those kinds of conversations up front on the exceptions.
I've got a question here. This is a really good one about experience for the investor versus the builder. Does the investor need to be experienced if the builder has done 3 new builds or more?
Yes, that's exactly what we're saying. So 2 different types of borrowers on Gound-Up. either the builder that's built 3 or more spec homes, or if it's the investor, we would require them to have done 3 or more spec homes as the investor.
With their capital in.
Correct. So if, when we get the question, I've never done this before, but my builder has built 400 homes, that does not count as experience on a ground up.
Correct. Good answer.
Okay, great.
Rose, I have a question. I have a question that we will answer. We get this.
Okay.
I get this call, and so does Lori, once a week. I've got a parcel of land. We're going to subdivide it. Has it been subdivided yet? No, but we're going to do that. What's your plan? We're going to make this parcel of land into 4 lots and build 4 homes. Will LendSure do that loan? Good question. Answer. Yes, we'll look at that. However, when we look at those, the builder's experience, their capital and assets will be reviewed first and upfront. You know, being able to afford to build 1 house with enough capital to get the project across the finish line is one thing. Doing 4 homes is another thing. So yes, we'll look at those. Do they have the funds on hand to get 4 projects across the finish line? And then you get into real detail around the pro forma, the budget, and when we're going to put funds out against the draws on what property at what time. So all that's got to be looked at in detail early before we close the loan.
And the timing of the lot split also,
Correct.
different areas could take, I don't know, 2 months. Other areas may take 9 months. So those are kinds of questions, again, that an experienced builder would know that information, right? They would know, yeah, I've done this before. I'm taking the parcel, I'm doing the lot split. I know how long permits take. I know all this information. We need to be presented with that information up front. We'll ask those questions.
Okay. I've got a couple of more questions. I think you guys went through this before, but I don't remember. About manufactured homes. Well, do you guys do manufactured homes?
We do not.
Okay, great. Next slide.
Yes. Thanks, Rose.
Market opportunity. It's as big for you as it is for us. Some of the niches we talked about, the cash out for those that qualify on the lot, that's a big one. The local builders always look at their banks first. Their interest rate might be better than ours. They probably are better than ours. So we find out, why the bank couldn't help you. Typically, it's what you see every day in non-QM lendings. The tax return may not have worked out, something like that. We don't ask for tax returns, so we'll look at the borrower's financial position. Banks tend to work with, the large builders. We do not. So that's the smaller builder is kind of coming our way, so we're happy to see that. Probably less competition with these loans as far as ourselves with other non-QM lenders. Not many people do them. LendSure is now in the business, and we're fairly bullish on what's out there and what's going to come at us in 2025.
Okay.
Rose, was this me? I think
Yes,
so.
it is.
So
Yes.
we're putting on display for you for both fix and flip as well as ground up potential borrowers. So I don't need to go through all this. You all have realtor partners that deal with investors. That's probably the best place to find these things. I know Jim and I have gone to lunch and learns here locally. We're in San Diego for investment clubs. So, sign up for that and go meet some people and you'll learn things there. So there's plenty of opportunity for you to find potential borrowers.
Lori, are manufactured homes the same as modular homes?
No, modular is different, and we do consider modular homes.
Very good.
Good answer.
I think I'm being graded by my boss right now when he says good answer. It's going to be in my performance review. So Rose, you had put this together for us about when you go on social media, you can find a flipper group. That's, it's a very technical term, right? First time.
Yeah, and this is an this is an actual screenshot. This isn't something that we did in Photoshop. The
Right.
idea being that you have all of these communities local, regional, that are flippers, that are asking questions, that are looking for resources, looking for help. You can go in there and join them and, listen to what they have to say, become part of that community and offer solutions to them. Remember, the market opportunity for flippers is huge. Every loan is a, buy, refi, do it again. So it's a really good, and you do one, you're likely to be recommended to other flippers.
Thanks, Rose. This is what our scenario portal looks like. A key to the scenario portal, they do not need to be under contract on fix and flip or even on ground up, but there needs to be an address. So I cannot approve these on a TBD, but they do not have to be under contract. Oftentimes on ground up, the city has not provided the actual address. We're in the middle of one right now. I think the address has changed 3 times. We're trying to close the loan. But if you don't have an address, they should at least have a street name or a development or a neighborhood so we can go look at it. But has to have an address for us to do this. This is about 20 questions. This is a dynamic application or scenario portal in that when you're done and that 0 complete turns to 100% complete, I see it right away. I pop in there within 5 or 10 minutes because I refresh it 100 times a day and get back to you right away and let you know I'm looking at it. So this is a good way for us to capture the information. It does ask for what does your borrower do, how long have they done it, what's their income. It definitely asks for that information. We recommend that you do not send this directly to your borrower. They never fill it out correctly because they're filling it out as a consumer, and guess what? They leave you off, and then I'm calling the borrower, but the first question out of my mouth is, you were working with a loan officer, right? What's their name? And I go back and I put your name in there. But this really is for you or your sales assistant to complete the scenario portal to get this going. This replaces an IRLA and a 1003.
Lori, I've got a ton of different questions about the timeline. How
good.
long does the process typically take? What's the timeline on closing, etc.?
Let's speak to a couple of timelines. From the time you put it into the scenario portal to getting you what we call a term sheet or a pre-qual is 1 to 2 business days. So we get those out to you very quickly so you can then present it to your borrower. Let's assume, for example, that we get one out today, and in this example, it's under contract and they're ready to go. There's the term sheet details out the 3 documents we need to order the appraisal, because we order the appraisal. The broker or loan officer does not. To get an appraisal ordered, all I need is a signed term sheet, an executed purchase contract, and the scope of work or contractor budget on a form that we send out with the pre-qual. In order then to move the file to underwriting, we need assets, LLC documents, title and company information, insurance quote, a fix and flip experience form, a couple of other documents. So in a perfect world, the appraisal is being done at the same time the file is being underwritten. We like to see 30 days close of escrow on the purchase contract. However, most of our loans are closing in 15 to 21 business days. And you didn't hear this from me, but we did close a handful of loans in 8 business days. That requires a dedicated seller, buyer, title company, insurance company. All the cylinders are running. We run fast, but in general, I would quote 15 to 21 business days from sending us the full package after pre-qual to close the loan.
Hey, Laura, you know what builders are really good at?
What are they good at?
They're really good at building homes and fixing homes. Sometimes they're not as good at paperwork.
Correct.
So those people we work with, and that can take that 8-day close to 12 to 20 to 25 to 30 days. Depends on who you're working with.
The appraisals we're ordering today, we send out the payment link, the borrower pays, assuming that the point of contact for access gets back to them very quickly. We're being quoted about 10 days to get the appraisal back. So again, if the borrower wants to pay for a rush, they can. I never recommend it. It probably works better to not pay for a rush and let myself and our account manager push the appraiser to get the appraisal to us sooner. But the appraisals being ordered today are coming back with a delivery date to LendSure of late January, early February. So about 10 days.
We get 2 numbers on the appraisal?
We get 2 numbers on the appraisal. We get an as-is value as well as the ARV or after rehab value. So those are the values. Now, keep in mind, before we send the term sheet, we do a search of comps in that area. So for example, if you tell me that it's going to be worth $800,000 when they're done, and all I find are comps in the $700,000 range, I'm going to pick up the phone and call you. Let's talk about the value. We may want to get the borrower, especially the experienced borrower, on the phone to walk through why they think it's going to be worth $800,000. But if we all agree, we may ask you for a CMA from the realtor, but we will try not to send you an approval that we haven't discussed up front that does not support the value with the comps that we find. But we do that up front. We do not want borrowers paying for appraisals when we know the value is not there and they're not going to make money. These are investor products, meaning investors who want return on their investment.
I'll share a stat with you that speaks to profitability. We had an employee of ours, a guy named Luke, look at 30 paid out loans that were fix and flip in nature. One of them might have been a new build. What we studied was the ARV number, where did it actually lay versus what the house sold for? In most cases, and I think Luke would tell us 70% of the time, the house actually sold for more than the ARV. What that says is the investor did very well. So there's huge opportunity in this business. There is a housing issue. So I think builders are going to be coming at us right and left. And another big thing for you guys is a builder doesn't build one house. They might build more, right? They're repeat customers.
Okay, I've got a couple of different questions about LLCs. Do you have to close in an LLC? And how many LLCs can be on a title?
You must close in an LLC or an S Corp. We can't close in a personal name, but we've closed more than one loan with 2 different LLCs. So if it's 2 LLCs, we can do it. We've done it. And, you know, for the borrower, the investor, there definitely are, you know, we're not attorneys, but we play them at work. There are legal and tax advantages to closing these loans in an LLC. We don't have any requirements about how long it has to be open. They can create it during this loan process. They just go online in the state located to create the LLC. It's probably an hour process and a couple $100.
Okay, great. And I've got questions about marketing materials. Yes, there are private label marketing materials for fix and flip, and the Gound-Up Construction ones are coming later this week. So in the email that I sent to you guys, I'll go ahead and send you a link to how to get them. Or you can go to LendSure.com and under broker resources, look for marketing materials. You fill out a little form and there you go. You get your private label resource kit so you can start reaching out to realtors and property investors and contractors and builders on this loan program. Let's see, what's the maximum number of units that can be financed per builder?
1 to 4.
1 to 4.
Okay. And well, let's go to the next slide here.
Excellent. I think we're almost to the end.
We're almost at the end.
There, that's Rosa's section.
This is what I was just talking about. There's the URL to go in and download it. So this has not just about fix and flip, but it also has our bridge phone program, marketing materials, our bank statements, foreign, national, just a ton of really good stuff. So you can start reaching out to your referral partners right away. So let's finish up.
Rose, I'm going to just say something really quickly while you're doing the questions. let's talk for 2 seconds about purchase contracts that are assignment of the purchase contract or come from a wholesaler. In general, we do not do those. So we're looking for those purchase contracts between the current owner and the current buyer. If there is a wholesaler involved, generally the answer is going to be no. I did get one approved this week with at a 70% or 30% into it. Initially, they said they would do it, and then they backed out. Generally, wholesalers do not want to tell us what they paid for it in December to turn around and sell it for $100,000 more in January. That's a concern for us. So if you see things like double escrows, stop and call me, or let's ask more questions, or when I believe there's a wholesaler is if it's a purchase and it's not an open market transaction and I can't find it online. It could be because the borrower investor is a realtor and they went to look at the property and decided to make an offer. That's completely okay. But be aware of assignment of purchase contracts and leads from wholesalers. More than likely, we can't do those. And the other piece has to do with the types of borrowers we can do. It's US citizens and green card only. We don't do ITINs on this product.
That was going to be my next question because I got several people asking about ITINs. So no on the ITINs.
Yes.
If a mortgage broker sends you a file, do you pay that mortgage broker a fee?
Yes, we do.
The fees, the compensation for a mortgage broker is worked out between the mortgage broker, loan officer, and that borrower. So it's borrower paid comp. We do not have a lender paid compensation program for these loans. Is that right, Lori?
Yes, but just to wrap that up, the term of the loan is a 12-month interest-only balloon with no prepay and no EPO. And the reason that's important is because LendSure also charges a loan origination fee to match that of the loan officer broker, plus a $15.95 underwriting fee. So if your fee is to broker the loan to LendSure, we will also charge the same $2 for a total of 4 points. If you charge 1.5, we'll charge 1.5 on this program as well as on the ground up. On larger deals, we can negotiate that down, but that's an important piece of a conversation that you have with the borrower before LendSure ever sees a loan. When they come into us with your fee of $275, the first thing I do before I look at anything is call you up and say, have you sold 5.5 points to this borrower? Because that's important. Because if the borrower says, I'm not willing to pay more than 2, we have to have a conversation before we look at the loan.
Laura, can the points be stacked?
If we are at lower ranges, Jim, is it 75 when sometimes we can, it's an exception for us. It's not automatic like on some of our other non-QM products. We did some stacking a year or so ago, then we stopped, and I think we're starting to get back into it. But if it is a deal that's at 80 or 85, there would be no stacking. It would have to be 75 and under, an exception basis. Ask me about that up front when you submit the deal into the scenario portal.
Okay. Now I've got a ton of questions about how many homes can be financed with one builder. And let's say, can a builder finance 30 duplexes, for example?
I don't believe at one time. I think we're limited to 5.
5.
5 at one time. Once they pay off, they can keep coming back.
Okay, great. And yes, I will send a copy of this slide deck to everybody. Look for an email from me in about an hour. And I think I answered those questions. Marketing materials. What's the maximum LTV on a fix and flip? And are the rehab costs financed?
Good question. So in fix and flip, we speak to LTC or loan to cost. Down payment is based on experience. So we're capped at 85, 15% down, if the borrower has completed 3 or more fix and sell or fix and hold in their name or the name of their LLC, their skin in the game. How we break this down is the loan closes as a regular purchase. The borrower comes to the closing, down payment and closing costs, and they own the property. We've approved 85% of the purchase plus, let's say, 85% of the construction. Rehab, no portion, $0, no funds are dispersed at closing for the rehab. So the loan closes. Day one, they go in the property tomorrow with their contractor. Let's say the first portion is demolition. They tear out the kitchen and the bathrooms. They request a draw. We send out an inspector. They say, yep, they demolished the inside of the property. Per their budget, that was going to be $20,000. They get a wire for $20,000 because that work has been done. So we call it a scope of work, a contractor budget. That's what's sent to the appraiser. That's why we order the appraisals, because that is what all work is going to be compared against going forward for the draws. What did the property look like when we started compared to what work has been done? They do the inspection, they wire the funds. It's in our best interest, as well as the borrower, to get those draws out quickly to get the project going and get it completed so the borrower can come back to you to refinance or list and sell the property.
If we funded all the money up front for the purchase and the construction, today we would probably have that ugly word called REO, meaning real estate owned, that lawyer would have to spend all day on figuring out who's going to finish the house and how we're going to sell it. So therefore, we can't fund, beyond what the purchase price is. But in the end, they'll get all their money as the project moves along. We want the loans to perform so that everybody is happy.
I define this as a purchase is cash in, so they bring closing costs and a down payment to the table and they're paying up front for the work. Refis, however, are cash out. So for that borrower, let's say, that paid the $200,000 cash for the property and has put $100,000 in and needs another $150,000, assuming there's a small mortgage on it, obviously we would pay that off. But in those cases, on the refis, we're able to include in our initial loan payoff of any liens, closing costs, and sometimes we're able to give them a little bit of the construction costs to keep going, depending on how the numbers work out. But you would know that, and the borrower would know that up front, how much cash we can give them. But on purchase, there's never funds advanced for the rehab, never.
Okay, and I've got a couple of questions, like what if I work with a LendSure account executive? Do I go to them? Do I go to you guys? And who do we work with to walk us through, parentheses, hold our hand on our first one?
Got it. So your other account executive is your account executive. They handle all of your non-QM products, everything, except for fix and sell, fix and hold, and ground up. Those come to me. But when you put it in the scenario portal, put their name it will ask you who the account executive is. It's not me, it's them. Put their name in there. This is all I do. So I have been pulled out of everything else. And if there's a fixed component or a build component, those come through Jim and our team, okay? I will do the hand holding. Happy to help. I will help you. Probably 5 times a day, I have calls with loan officers and borrowers with your permission to walk the borrower through. You guys tell me, sell your own loan. You did the pre-qual, Lori. Get on the phone, talk to my borrower. And it's a training for you also, but happy to arrange those calls. We do it all the time.
If you're working with an AE, do ask them about their great bridge loan for move-up buyers. Property A is for sale. They want to buy a new and bigger house. Great program at LendSure, a no payment type of a loan. Won't give you details, but if you haven't talked to your AE about our bridge loan product, it's a wonderful instrument to get people into their new dream homes. Fix and flip, ground up, call this lady right here.
All right, can you do a purchase involving a gift of equity, parentheses, father to son, on an existing property with a $300,000 addition?
Yes, we can look at gifts, particularly whether in the family. However, how much of that gift is it 50% that the son has half and dad has half? The number of dollars that the actual borrower is into the deal will matter. Do we do 100% gifts? Probably not. These are investors. They should have some money. They're investors.
We want them to invest.
All right, and the person sitting next to Jim is Lori Williams. So I'll make sure to include her contact info when I send out that thank you email. Are there different rules for Texas on these loans?
No, they're non-owner. They're not covered by Texas cash out. There's no TRID, there's no LE. Except for we know it's snowing in Austin and Houston today.
Business purpose only loan, BPO.
Okay, and I think I know the answer, but I'm going to let you guys answer this one. What's the LTC if they don't have experience and haven't done three homes?
75 generally. However, if they have strong FICO, 750 and over, and strong assets, and Jim loves the project, I can get to 80 with 20% down. But in general, you've never done this before, on a fix and sell or a fix and hold, we're going to require 25% cash down.
Can we do business in states where we are not licensed?
You need to check the licensing grid on, I believe it's on our website, Rose, correct? Okay,
Yes.
and it details out for business purpose loans whether you need to be licensed or not. I don't have all 50 states memorized, but you can.
Many states, yes. Some states, no. You can add Nevada to the no.
Yeah, Nevada's a no. We know that.
You need a license in Nevada, but
Yeah.
check the list.
Check the list.
We don't have it memorized.
Yeah, I don't. Next
Okay.
week I'll have it memorized, Jim.
Rose, we got to go to a call here in about 10 minutes. No,
All
7.
More
All
questions?
right.
Any final questions?
Okay, the final questions. Oh my goodness, there's so many. By the way, I know that there's a bunch of questions that are very specific scenarios. We want to be able to give you the most complete answers possible, so I'm not going to address them here on this call, but please email me, just respond to that email with that scenario, and I'll get it to Lori and Jim right away.
We sit like 3 feet apart, so it's all good.
All right, sounds good. You already answered about stacking. What is the average compensation for this?
Brokers or LendSure?
I don't know. It says that what is the average compensation, presumably for brokers?
Somewhere between 1 and 2, and that's a general answer. I would say between 1 and 2. Compensation for LendSure, never enough. Ha ha, just kidding.
If your broker agreement with LendSure requires you to get, let's say, 275, I've had many instances where I've directed the loan officer to go to their compliance department and ask for a reduction down to 2 or 175 because these loans may not require a processor on your end. We're ordering the appraisal, you're not. We're working with your borrowers directly with your permission to collect the conditions. And there's no TRID, where there's no income to do. So I think many loan officers have been successful in going directly to their compliance department and getting that comp on these products lowered below 2.25 or 275, whatever the standard is.
Okay. And I've got a question just to clarify, no foreign national even for DSCR?
No, this product for us is, we're only covering fix and sell, fix and hold, and ground up. That doesn't allow the foreign national.
DS,
All right.
you're good on DSCR.
Yeah, there's a contact your other AE for that.
All right, and this is going to be the final question. Can you close in an S Corp?
Yes,
Yes.
we can.
All right, well, with that, I want to say thank you for everyone for joining. Again, look for an email from me, Rose Waldy, in about an hour, and that's going to have the recording of the webinar. It's going to have a link to the slide deck for the webinar. I'll also include a link for the private label resources, and I'll even paste in Laura's contact information in case you want to contact her. So thank you so much for joining. Jim, any final words?
Big opportunity for all of us. Take advantage of it. Remember one thing. We don't do 100% financing, but we can get them to 85%, which means they're only putting how much down, Laurie?
15%.
That's a deal.
Thanks, you guys.
All right. Thank you, everybody.
Great day.
Thanks.
Bye. How many?
We got over 4.